Good afternoon, everybody. Event Trader here. I am going to be joined by Trend Tracker. That you there, Craig?
I'm here, guys.
How are you
How's it going,
doing?
Jeff?
I'm doing good. Just taking a quick look around the markets before we break into this, Craig. Not a lot of excitement here in the afternoon. Pretty much been going sideways ever since that initial rally up. Impressive that we've been able to hold up these gains here. I would say the SPY, we got it trading right around 276.80. The Qs we got rolling in right around that 171.66 level. So a little bit of weakness after that initial run that Brett made a nice call in to grab a couple of points. And then we've got the Diamonds DIA sitting there. They've definitely been the strongest as that's edging towards session highs here. Quick look around at some of the different segments. The IYZ we have up 2.1%. Certainly one of the big winners today. We've got the XLF financials up 1.9% on the session. The XLV healthcare up 1.3%. And energy also up 1.3%. Really the key drivers going on in today's action. The advanced decline line has remained firmly in bullish territory throughout the course of the session. We're at about 3,000 right now total there. So, with that being said, Craig, welcome to the Trader Audio. We've got a couple of names that you've been playing around with the last couple of days here, and some key upcoming earnings results too that we'll want to break into. So first, let's take a look at the trade desk, ticker symbol TTD. I know a lot of people are going to be asking about this because obviously we've got earnings going on next week, and a key event as always for these guys. We've seen some nice breakouts following some pretty strong recent quarters. What are some of the things that we want to be looking for here in the trade desk, and what is your plan with your position ahead of ahead of this print?
Yeah, so I just trimmed a little bit today. I don't really have too much of a call into the quarter. I expect another, solid beat. It's probably going to come down more to guidance. The expectation for 2019 revenue growth was high 20s, or about 27%, I want to say, last summer, and now it's kind of up to 33%. Their
Are you
guidance.
worried that analysts are getting ahead of themselves yet, or not? Or
No, I think
those numbers?
no, I don't think there's risk to that number at all. They're growing. They're set to come in at 50, low 50s. I mean, I'm assuming they're going to beat. So, low 50% growth, just over 50% for 2018. I don't see any reason why that really can't continue. I mean, they've done a good job of managing expectations in general, so I would assume that he wants to be able to raise every quarter. So it might not be, the guidance might not come in way above. It might be closer to inline, so that they can kind of raise throughout the year, but the connected TV channel should serve as a huge tailwind again this year in 2019. It really just started growing, really started from nothing last year. So, as probably everybody knows by now, I'm kind of uber bullish on these guys.
I know a lot of people are probably looking at that price run from the 40s, which I know you were in, and we'll break into that too, just to provide a little bit more insight into your trading philosophy and investment style. But when I was running in the 40s, obviously you see this run up to 156, and the first thing that you're thinking of is that this valuation has to be out through the roof. But I see in your notes it's still less than a $7 billion valuation, then, right?
Yeah, and that's obviously an important factor to consider. That the market cap is a lot more important than the stock price. I mean, nobody likes trading $2,000 Amazon or even $1,000 Google. But when it comes to the value of the company, it's not what important. I did post an update to for a lot of these cloud stock valuations. A multiple of earnings or sales is what I tend to look at, or EV/EBITDA, if you want to kind of take the balance sheet into consideration. For a lot of these cloud software.
Real quick, Craig, on this for anybody following at home, if you do a ticker search for trend, the piece that he's talking about is posted at 1307, and he's got that link for the updated cloud software stock valuations for reference.
Yeah, it's definitely an interesting thing if you want to check that out. It's the last bullet point of that post I for my comment at 1307. There's a lot of stocks that are trading with a double-digit enterprise value to revenue, so that backs out the cash and adds back the debt. So essentially, the enterprise value is better to look at than the market cap because it takes into consideration the balance sheet. So if you did want to if you were trying to acquire them or whatever, take that into consideration. And we have seen a lot of deals in the software space at mid-teens even EV revenue multiple, which a few years ago would have sounded crazy, but I think it was Qualtrics, which is like a superior Survey Monkey, a little higher quality with more focus on the enterprise market. I think they did a good job of selling themselves as like instead of like a survey company, it was, I can't remember the name that they use now, that made it sound a lot better. Customer experience enterprise software company. Anyway, S&P or SAP acquired them at close to like 20 times sales. That was right before they came public. So now, we do have companies that are willing to pay hefty multiples like that. So the stock, the one that's at the top of that list that I posted, ESTC, Elastic, is a very recent IPO. It's trading at 20 times sales. It's hard for me to get excited about buying something at 20 times sales because even if they're growing 40, 50, I guess they're maybe even closer to 60%, but I don't know, it just doesn't leave a lot of room for upside, at least near term in my view. On a significant pullback, I would love to grab it, love to buy some, but
and the ticker symbol on that again was?
ESTC. It's that first one that's on that list. It's the most expensive one that I have found. Maybe now Canopy Growth and Tilray and the cannabis stocks they trade with even higher sales multiples, but those are kind of their own little animal because there's so much hype, and I think a lot more consumer interest, retail interest behind those. There's just a ton of speculation, so there's kind of a ton of speculative premium built up in those, and for good reason. It's a industry that is just kind of getting off the ground, so there's a long runway for growth, but that's why a lot of these enterprise software stocks are attractive too, because somebody like the Trade Desk or Elastic or a lot of these that are on this list, there's a reasonable expectation for them to grow 20, 30, 40 or even higher percent for a while. So, growth, momentum investors see a lot of opportunity there. It's definitely an interesting space nowadays as software becomes more and more important in the world.
All right, let's take a look at a recent trade that you took, and that's ONDK. Now, one of the things that I'd like to point out to people is your investment style, where you're not necessarily looking for just a quick hit on something. You're willing to sit in for a while, and kind of using that as an explanation, just throw in the Trade Desk. You were in here all through this 45, the rally up to 60, and the drop back down to 45. You held pretty steady, and basically your philosophy is you look for a good story, for a company that's looking at a good valuation and room for upside growth, and you're pretty good at hitting this. So the reason why I'm pointing that out is I know OnDeck is one that hasn't really gone in your favor early. Certainly a little bit of a sell-off post-earnings going on there. But that's not something that really rattles you right off the bat, right? I mean, you're expecting a little bit of volatility to come in, but when you're looking at it on deck, you're looking at the relationship with JP Morgan that they're building. You're looking at the market share that they could potentially get in that small business. So you want to just highlight again what from on deck, ticker symbol ONDK, was sticking out to you, and also you can mention the recent price action and your thoughts around what's gone on around earnings.
Yeah, I mean, I'm not gonna lie. I have to own up to this one. This was I love it at this price. I really like it long term as an investment here. But when you put a call out the day before they report, and my post earnings analysis was bullish as well. I overlooked the downside earnings guidance. I mean, I did mention it, but I'm not gonna try and sugarcoat it. It was not a great call for me.
Well, it's still early, though, is the point, right? I mean,
Sure.
What would have you? I guess probably a question would be, what would have you throwing in the towel?
I mean, I mentioned this week that if the economy takes a downturn, they're a small business lender, so there's obviously a lot of economic sensitivity. I know you had some quite bearish comments on like fintech lenders and stuff.
Yeah, but that's in a downturn, like you're saying. So I don't think we've seen
exactly
that yet.
No, I mean I think this is a very underappreciated, unique asset. I mean, it's trading in both earnings and price to book, similar to your average like higher quality regional bank. And these guys are growing a lot faster, and they are licensing their lending platform, which is essentially a software as a service business that could garner a 5 or 10 sales multiple. Excuse me.
So this isn't just a lender. This is also a possible SaaS play.
Well, it is. Yeah. I mean, JP Morgan licenses their online lending software.
Does OnDeck break out those numbers yet?
Yeah, I mean, it was only like 4 or 5 million for the quarter.
Okay.
But they added PNC last year, and they said they're still kind of piloting them. So that it's really yet to kind of see tangible results. They said that, they have a pipeline of banks that they're talking to add more. So there is some expectation that they will add at least, hopefully, 1 or 2 more this year. If they get momentum in that regard, it could certainly cause a re-rating in the stock. But yeah, I mean, it's more of a long-term play. I mean, if you look at this, if you look at the chart since the IPO, it kind of came out. It looks like it came out with far too much optimism. In the 20s, it's probably some company that was going to, change the game. Online lending. It was exciting as a new model. It got, sold in the IPO as, the next generation of banking, whatever you want to call it. At this point, they've reported 5 strong quarters in a row. They're executing. They're doing well. It got hit because they guided down on profit, in my view. And now, so that's certainly understandable. If you guide down profit, it's going to weigh on the stock.
Not uncommon from what we've seen from many of the semis, or really the majority of people.
Yeah, I mean, there's stocks that I think the base case. What we see, the base case is what you see is a company beats earnings and they kind of temper expectations next quarter so they can beat them again, right? And because it's a growth company, and because it's more of a growth story than a traditional bank or just any traditional company, I like the fact that their business is humming along and they're growing. I think it's, as a long-term investor, you want them to be investing in growth so that they can continue to, take market share or grow long-term. I think Grubhub was one where they guided down profit because they're investing in their business. Again, that one actually reversed pretty well, but again, that's, you got to take it on a case-by-case basis, right? So I do think there is a good parallel between Grubhub, which took a few years. They were reporting pretty strong results for a while, and the street kind of hated it and was concerned about Uber and all this different competition. And then eventually the street starts to warm up to the story and realizes that they're doing really well. I had compared Stitch Fix after the IPO to Grubhub, and that thing kind of took off and then kind of came back down. But I think ONDK is kind of a similar underappreciated story, and even Sonos kind of falls in that category. I know we got some feedback about Sonos. These are good companies that are kind of the leader in their field, and they're executing. The valuation is reasonable, so I think it's just a matter of time until the market starts to appreciate them for what they are, instead of skepticism kind of taking the front, taking the dominant sentiment position, I guess you could say.
All right, now switching gears from the software side, one name that you recently got involved with that you like is Aimune, ticker symbol AIMT. Why don't you tell us a little bit more about what you see in them? I know they got that peanut allergy. I believe that they're getting close for an FDA ruling on that. Is that right?
So they applied. They applied to the FDA for the new drug. Now, the next, I guess, update on that will be the FDA will say, okay, we're accepting this application, and then from there it'll take, 3 to 6 months for them to actually approve it. So, I totally understand being turned off a lot of times by biotech because of the binary outcomes, with when they do report data. Now, the data for these guys was very positive. You could see it on the weekly chart. What was it, it was last October, or if it was February of 2018, if it was October 2017, or about a year ago. But they reported they had some DBVT, which has a competitive product going after the same indication, but AIMT has like the strongest drug. And it's a huge market, unmet need. So the data is already out there. The expectation is that it should get approved. So I view, once all the data is out, it's sort of a de-risked asset. Now this thing is kind of pulled back into support. I really like this one at this level. I think it can get back towards 30 upon approval this year, and with a successful.
So 30 would be a target you'd have if it was to be approved.
Biotechs are
tricky.
Are an interesting. Yeah, they're I've had some big successes and I've had some big failures in biotech, so I sort of pulled back from it for a while. But if you own a biotech stock going into a phase 1 or 2 data readout, then it sort of is a gamble. If you're a scientist and really study the biology and the chemistry behind all of it, then you have a big advantage. I'm obviously not a scientist. I studied finance, but in this case, I'm going off of what the biotech analysts and industry perceive it to be, or what their assessment of the results were. And, sometimes a little bit of, common sense can go a long way, where this is the peanut allergy thing. Luckily, I'm not allergic to peanuts because I eat peanut butter every day, but it's a big issue now. It's a big market. So, this is an oral immunotherapy, so it basically desensitizes children, so that if they are exposed to a peanut or two, they don't go into anaphylactic shock, or they don't have a severe allergic reaction, and so it has huge potential. Now, if you back the cash out, it's like roughly $1 billion company, and so I do think it can be back closer to 30 upon approval, and if they have a successful launch, this thing could turn into a momentum stock very easily. And there's a decent short interest in it right now. So, yeah, I really like this one.
Okay, and just to double check on that short interest, I got it coming in at 14% or so, right? So, pretty good size short interest there. Now, another name that you mentioned in your report that reports on the 21st of next week is Vonage, ticker symbol VG. Considering adding to this position, we could talk a little bit about your current size in there. And you make an interesting comment here where you note that it's a third of its legacy voice over internet, and the rest is a mix between RNG and Twilio, two tickers that have been really strong, two companies that have been strong. So right there's a pretty interesting look at the company model. So why don't you tell us what would get you into an additional piece of Vonage, and what are you looking for in the earnings?
Yeah, well, I mean, I'm not really making a call on the quarter or anything, but I've owned this one since August of 2016. So Vonage, the legacy business, what most people would be familiar with is the boring telephone over the internet service. So, that's kind of like a glacier. It's slowly going down, but it is producing a lot of cash. So back in 2016, they acquired a business called Nexmo, which was basically a communications platform as a service, which is what Twilio is, a smaller competitor to Twilio. So that's why when I first got in, it was a little under $6. I've taken profits on it a few times along the way. Stock got up to, 15 or 16 late last year, and or I guess late summer, early fall of last year. And it was really just kind of one soft quarter that really crushed the stock. I mean, it caused almost a 50% drawdown. Obviously, the broader market weakness didn't help in December. But now it's kind of starting to break back out along with everything else. But if we go back to that software valuation table that I posted, it's the last one at the very bottom. So this stock is trading a little over 2 times sales. More importantly, it's a pretty reasonable EV/EBITDA multiple. So a third of their business is this boring glacier that's at least producing cash, but then they have a business service segment, which is unified communications as a service, which is what RNG is, and then there's the Nexmo business, which is what Twilio is. So their business services revenue, so enterprise software, I think the growth is coming in around 40% this year. Now it's going to slow next year, but they did buy like a call center, I think a few months ago. This is just basically a relative value play. The stock is extremely cheap compared to, a lot of the sexier software names out there. And now, because it's pulled back so much, I'm kind of interested in adding back to it here a little bit. I don't have a crystal ball on this quarter or anything, but again, as a longer term holding, I think this is a good entry point.
All right, and then we're going to take a look at Sage, another pharma name that you mentioned here. You like this more on pullbacks, just pulling up the chart, obviously. Been a big runner, running from that 92 level at the start of the year. I'm assuming there had to have been some data in that run from 92 to 140 on that pop. And it's rallied to 160 since then. What was going on with Sage on that big spike up, and what is it that you like about it here?
Yeah, so that data, I was fortunate to get in ahead of that big pop. So that data kind of solidified the potential for a blockbuster depression drug. The current standard of care, the depression is a huge market. The current standard of care, which is like an SSRI, a selective serotonin uptake inhibitor, that's been the standard of care for 30 years or something, and that's a huge drug. Depression is a huge market, unfortunately, in this country, and so they have the potential to really kind of disrupt that market. So this is, again, in a sense, a de-risked asset like AIMT. They have an intravenous version of a drug that should be getting to market this year for postpartum depression. But the bigger market is for mild to or moderate to basically just normal depression. And the data that was earlier this year was for an oral version of the drug. So the IV version has to be administered in a hospital. So the commercialization and sell-through, the hopes for it are fairly low. But the oral version of it also had very strong data. And anything central nervous system, brain essentially, is very difficult. It's kind of very rare that we see success in this kind of stuff. So Sage's plan is to go it alone. In other words, they're not looking to sell, because somebody like Biogen or a number of other large pharmas could be interested, given the fact that they have the potential for a blockbuster drug. As you can see, the stock has had a huge run, so I wouldn't necessarily want to chase it. But on pullbacks, it's worth buying, because they could have a blockbuster drug in depression. So it looks like the average price target on the street is around $200 a share. So the risk reward isn't there necessarily right here, but a pullback, it would get interesting again on a pullback. This is, and I'm not, again, if a takeover is your main part of your thesis, then that's not usually a good thing. But as we've seen in both the software and biotech space, you could wake up one morning, even though they have said that they plan to remain independent. If you get an offer you can't refuse or whatever, it's not out of the question that you could wake up to a takeover at a very significant premium.
All right. Getting a feedback, Craig. I think this was Robert. I don't think this was you, but somebody asking about AMPH, Amphastar Pharmaceuticals, that has that upcoming nasal spray that's supposed to come. Were you in on that one? I know Robert had mentioned it a couple of weeks ago.
I don't know that one at all, to be honest. Okay. I think it was Robert who.
Yeah, nice call by him. Another nice call that he had too, and let's ask you about this, Craig. ROKU's got earnings next week. You got any thoughts on that?
Yeah. So that's a leader in the connected TV space. So it's the same kind of a similar growth story to the Trade Desk. I do like this one a lot. Their business model is very savvy. The CEO I think he invented the DVR, sold it to TiVo. He worked at Netflix, and now he started Roku. So distributing these streaming devices, licensing it to TV manufacturers, and now he's building a content distribution advertising business on top of that. I've been covering it, for the base level on in-play since the IPO. I have to look at it a little closer to really, I don't really have. I did buy this one not too far below. Where was it? Looking for November. Yeah, I think it sold off in response to earnings, and I should have been more aggressive adding in December. You can say that about pretty much everything, but it's trading at like 6 times sales. So the hardware business is kind of a loss leader, but their advertising business is growing 60-80%, and that's high margin. There's really nothing. It looks like there's really nothing that's stopping them from growing this advertising business for the foreseeable future at a very healthy rate, very good margins. It's you got to hand it to this guy. Wood is his name, I think. Pretty savvy guy to come up with this whole platform and idea. So now the trade, you can buy ads on Roku through the Trade Desk's platform. You can say that about Spotify, Hulu, a bunch of other really high growth channels as well with respect to the Trade Desk. But at 6 times sales with healthy margins, the way that it's growing, I'm trying to pull up the last quarter, but of course they just do this shareholder letter on their website, so I can't pull it up real quick. But I like Roku. I think it'll mostly come down to the EBITDA guidance next week. So they're expected to come in about 42% revenue growth in 2018, and the estimate for 2019 is 35%. This is one that will probably get hit if they don't kind of deliver. And with the Trade Desk, I'm not too worried about them guiding down. Where Roku, I'd have to dig into it a little bit more to see how confident I am in the guidance, or to assess how much of a risk the guidance will be. But they will guide for revenue and EBITDA for Q1 and the full year, so that'll kind of be the key. But yeah, it's at 6 times sales relative to some of these other ones on this list. It's just advertising revenue. It's not a super sexy enterprise software business. It's just advertising. But that's what the Trade Desk and Google and Facebook and Twitter and Snap and all of them are. So the ad market is big. There's plenty of room for a lot of success, as we've seen over the years. I don't know. Do you have any thoughts on it? Do you have any questions? I feel like I'm kind of just talking to myself here.
I'm sorry, Craig. I was just listening to you. I haven't followed Roku too closely. I mean, I did like the call by Robert. I like the space, and as somebody that that pulled the plug, this entire streaming advertising model for me is certainly something that's of interest. So coming up to some key resistance levels and a little bit of skittishness going around earnings. So for me, I'm not looking to add to it going ahead of the report, but just going to kind of wait to see how things pull out. And if we saw a little bit of a dip back to that 42 level or something in reaction to earnings, which I thought was a little bit of a too worrisome of a profit-taking move by people, then I'd be looking to jump in. But
Yeah.
for me personally, I'm not looking to chase into it, but I'm going to be keeping an eye out for the earnings preview for that for sure. And kind of use that as a model for myself.
Yeah.
With earnings in mind, Craig, one thing that'd be interesting is I talked about it a couple of days ago, and I'm starting to see a few comments here and there. People starting to talk about an earnings recession, which is obviously 2 quarters in a row of year-over-year earnings declines. I was reminding people we've got some tough comps coming up against the Q1 earnings just because we saw those tax cuts for corporations come into play. What have you been seeing so far early on with these Q1 outlooks? I know you had mentioned something to me about that earlier that I found interesting.
Yeah. I'm glad you brought that up because so at what is it, 12:19, there's a comment posted under SPY, which is kind of an earnings scorecard update. So I just posted that this morning, and it's interesting. So earnings are expected to fall 2.5% right now for the first quarter. And now maybe that falls a little further here over the last few weeks of Q4 earnings season, but earnings, usually come in modestly better than what the street expects. It's kind of this quarterly cycle. Every quarter, estimates kind of get pared down for the next quarter. Like I said, the base case is companies warn a little bit about next quarter so that they can, surprise to the upside 3 months down the road. So, we're definitely seeing some serious margin issues, and we're coming off record margins, so it's not a shock. But as there's softness in China and Europe, some of the emerging markets. Obviously, the tariffs aren't helping. There's rising costs from higher rates, higher wages, transportation costs. There's a lot of excuses out there for why profits are coming down. And like you said, the tax benefit, at least year over year, is now gone. So we had a big boost 4 quarters in a row from the tax break. That's gone. So
what's 2018 shaping up to be for the year on a year-over-year basis? Have you seen those numbers? I know we had like around 20% plus in Q3, and Q2 and Q3. Any idea what the year-over-year is looking like?
It's coming in at 20.
20, okay.
20, exactly. So with sales up 9%.
Have they given any cutoff on what percentage of that was due to the corporate tax cuts?
You know what? I could look it up on FactSet real quick. So basically, you can look at the EBIT growth, and it's better. So it's before tax, and it's I want to say low teens, low double digits. It's still very healthy. So sales are up 9. So looking at 2018, we had earnings up 20%, sales up 9%. Obviously, sales up 9% is very strong. Coming to this year, it's looking like 5% and 5%, or a little just below there. So, a few months ago, expectations for this year were like 10% earnings growth. And to be honest, that's kind of just like the par for the course, for lack of a better term. Analysts always kind of project out high single digit, low double digit, somewhere around there, like 10%. They're always optimistic. If because the economy is doing well, right? If we were in a recession, or if things weren't going so well, then strategists wouldn't be looking for 10% earnings growth. But if you talk about the strategists, or just from the bottoms up on all these companies, they have an optimistic view, and then so come January, February, we actually get to see how realistic those estimates are. So now Q1 has been pared down to, it's fallen all the way down to -2, and then we're looking at like low single digits for Q2, Q3, and then I think closer to high single digits in Q4 to get us up to, roughly 5% for the year. So as you can see, they kind of assume it's going to be all good, and as we get closer, the expectations get kind of pared down a bit.
Now, what I had seen so far for the early expectations for 2019 is for Q1 and 3 to be down slightly, and then I saw 6% growth coming in Q2 and Q4. Are they the numbers that you've been seeing?
I think it was more of a steady improvement, so like throughout the year. So as of right now, it was low single-digit growth in Q2 and Q3, and then a little better than that, mid or upper single digits in Q4. And it's kind of a function of just comparisons from last year, right? So Q3 was the peak. I want to say last year, 20-something% growth, where now Q4, what is it coming in at? 13%. So the Q4 that ended last year coming in at 13%. So that's a little lower than what we saw in the earlier quarters. So it's a function of assuming that nothing's going to change, that the economy is not going to really worsen, and that everything will still be okay, and then just a function of the comp from the year before. You know what I mean?
Well, no, I know exactly what you mean, because I was actually looking. BMO had an interesting note out on this, where the last 6 earnings recessions have not caused any sort of an economic recession. In fact, we had 6 straight quarters of falling profits in 2015 and 2016 that didn't culminate into an economic recession. And actually, stock markets have done well going into these earnings recessions, rising by an average of 3.9%. I saw in the 3 months ahead of the first expected earnings fall. So, like you were saying, Craig, you got to kind of take these into consideration, and I think a lot of people will be discounting just because of the comps given the tax cuts.
Yeah. Well, yeah, like you said, I think it was like the commodities super cycle that kind of came to an end there, late 2015, early 2016, which kind of just trashed all of the numbers for the S&P 500, because energy and materials were just,
of course, got destroyed with the oil prices dipping. So
yeah, and it took a while. It took many quarters for them to kind of they declined for a while, so it went from a drag for a few quarters, and then that turns into just easy compares a year later. So then it kind of boosts growth a little bit. But yeah, the commodity, certainly the market corrected pretty hard. Was it early 2016? And because I think the Fed had just kind of started tightening too. But if as long as everything is still kind of doing okay, then the market should do okay too, right? And
yeah,
especially with a focus on more software stocks and stuff. I mean, they're going to get hit with everything else, but a lot, so the trade desk is an advertising story, right? So that is sensitive to the economy. But if it's more of an enterprise software story, like a lot of the hot ones are, their business isn't necessarily even going to get hit that hard if there is a slowdown. So I don't know, something to keep in mind.
Yeah, definitely something to keep in mind, and something that I guarantee we're going to be seeing a lot more commentary on. I guess the key thing that Craig and I would pass along is don't get overly excited about this. The numbers bear out that this doesn't always point towards an economic recession, but it's definitely something that we want to keep an eye out on as we're searching around in a rising environment here. What could upset the apple cart?
Yeah, so right now it's like negative 2.5 for Q1, and for Q2 it's maybe positive 2 or 3 or 4. But again, we'll see what it's pretty likely that 2.5. It could certainly fall further near term, but then whatever that number expectation is come early April, it'll probably come in a little better than that. And then whatever the expectation for Q2 is in early April, it'll come down, and then it'll hit a level where then the companies will then be able to exceed that Q2 level. So I mean, it could come in flat for Q1, and we might not have any negative numbers, or we could get a mild earnings recession, assuming the economy doesn't fall apart. I would think it would kind of bounce back, but again, we don't have a crystal ball. So,
Yeah, exactly.
With all the trade war stuff and the Fed supposedly friendly now. So yeah, I mean, obviously there's a lot in the air, but. Yeah, the earnings recession, I don't know what I would peg it at right now. 2 quarters of negative. It's certainly possible.
Yeah.
Certainly possible.
All right, well, something we'll keep an eye out on, and I highly recommend checking out Craig's SPY comment from earlier today. It's got some pretty good nuggets on the earnings season on what we've seen there. So, hey, Craig, thanks a lot for joining us today. I'm sure the users, the subs, really appreciate your commentary on some of your recent trades, and we're going to try to have you back on a little bit more regular basis.
Sounds good. Thanks for having me, Gavin. I do. I'm not happy with ONDK, and honestly, believe it or not, as you know, it feels worse to have other people lose money than it does for me to lose money myself. I don't like it at all, so I do feel bad about how I handled it.
It's okay.
But I
TTD, there was some nail biting going on too, and that turned out well.
Oh yeah, I mean, I think I was looking like a crazy person for a while there, going back about a year and a half, because I was kind of posting about TTD every day because I was so compelled and excited about it. So when I do find something that I really like, you got to go for it. So I do think ONDK will work with some time, it's not an easy game. So
Yeah, exactly. All right. Well, Craig, you take care. You have a great weekend, and we'll talk to you soon.
thanks, Gav. You too.
All right.